Hello, glad to be here with you today. My name is Robert Dye. I'm the Chief Economist of Comerica Bank. We're one of the largest banks headquartered in Texas. Of course, we have a long history through the state of Michigan, having grown up there many, many years ago. One of the longest histories in the financial services industry, now in our 174th year. And the interesting thing about this year, of course, are the events that we're living through. And little did we know at the start of this year that this would turn out to be such a historic year for unfortunately bad reasons, especially as an economist. I find myself for the first time in my career having to learn about epidemiology and viruses and waves of infection and social mitigation techniques and lots of things I didn't anticipate learning through my career. But it has been a challenge. I think we as economists are starting to get a handle on these events that are no doubt going to be historic. And we're going to discuss today what the path through these historic events may look like. And a lot of this really depends on the epidemiology, the path of the virus. So it's a combination economic outlook, virus outlook. You can't really separate those two things right now. So let's go ahead and get started. And I want to start just with something you all know right now. You all know that economic uncertainty is very high. And here's a graph from the Economic Policy Uncertainty Institute that simply demonstrates that. And this is a research group that pulls together the dispersion of economist forecasts. They do a Google search of terms related to uncertainty. They look at fiscal, tax collections, things like that. And they put together this index that, again, simply states the obvious, that as we get to the right-hand side here, the amount of uncertainty that we're all operating under is record-setting. It goes beyond the events of 9/11. It goes beyond the Great Recession of 2008. 2009. So we're into brand new territory here. And what we're going to do now for the rest of this presentation is try to figure out what the path out of this and what the general contours look like. And I think right now the best we can do is really talk about general contours. I'll give you some specific numbers, but it's such a wide range in terms of confidence intervals around the numbers. It's the contours that matter right now. So when we think about the COVID economy, I put together this slide here just to capture a lot of what's going on one page and try to give us a little graphic to work with. And to date, the COVID problem has been primarily a Northern Hemisphere problem, starting in Asia, migrating to the US and the rest of North America, migrating to Europe, and then back and forth. The response to the key policy response, the key government response, I should say, to the event has been social mitigation policy. And that's what's causing the chief economic event that we're dealing with right now. And social mitigation policy has really led to three different drags on the overall economy that we're currently experiencing. One is supply chain disruption. And as you all know, we live in a world with very long and somewhat fragile supply chains. We're learning how fragile they are now. And what happens in China, what happens in India, what happens in Japan and Europe really does matter to what's happening in the US in terms of our ability to do our work here and to get the goods and services we need to keep our economy functioning. In addition to supply chain disruption, we've seen a good deal of demand curtailment and demand destruction. Now, the difference between demand curtailment and demand destruction is very simple. When we curtail demand, we will get it back later, and we'll have pent-up demand over time. And a good example of demand curtailment right now are April auto sales, going down to a 9 million unit sales rate, up from down from February's 18 million. So from February through March into April, we've cut the sales rate in half. But we all know that cars wear out. And so that pent-up demand hasn't gone away, and we will eventually get most of those sales back. So that's demand curtailment. Demand destruction is when we don't get that demand back. And we might see that most clearly in the airlines and say cruise ships and those types of vacation related industries where we're not necessarily going to be taking 2 or 3 or 4 extra vacations next year because we didn't take 1 or 2 this year. We're simply not going to get that demand back. So that combination of a supply chain disruption, demand curtailment, demand destruction is really what's weighing on the economy right now in a significant way. We already know that first quarter real GDP growth came down, declined at a 4.8% annualized rate. So the contraction has already started in the US economy. We see that in the quarterly GDP numbers. And it really started in March. January and February were actually pretty good months for the US economy, but social mitigation was rolled out through March, and then the economy started contracting. And so what we'll probably will look back at these events and say the recession that we're now in, the coronavirus or the COVID recession, really started in March of 2020. When we think about the second quarter, where we are now, we're looking at a much deeper contraction than the first quarter. And the guesses there, the ranges are anywhere from 15 to 20% on the shallow side to 40, 50, 60% on the deep side on an annualized basis. So on a quarter-to-quarter basis, about a fourth of that. So a 60% annualized slide is about a 15% quarter-to-quarter. But still, that would represent a historic contraction in the US economy due to the 3 effects from social mitigation: supply chain disruption, demand curtailment, demand destruction. In addition to what's going on in terms of social mitigation policy, there are other forces acting on the economy right now, and we'd be talking a lot about these even if we weren't talking about the coronavirus and its impact. And one of those, of course, is Boeing, a major US aerospace company, airliner manufacturing that reaches into Michigan, especially Western Michigan, where we have a concentration of manufacturers who are focused on components, including GE aircraft, making engines for going into the Boeing aircraft. So Boeing obviously was having a lot of problems with its 737 MAX airliner and canceled production on that, at least for a short period of time. The good news is that Boeing is now starting to ramp up production of various airliners again, but they too, like every other company in America, is caught up in coronavirus. So they've had their own very specific and idiosyncratic issue with the 737 MAX, but they're also a victim now of reduced air travel and significantly reduced orders going forward. So even though Boeing is coming back online or has come back online at the end of April into early May, they're coming back at a much reduced rate. And so this huge company with reach throughout the US in terms of its supply chains coming back online, but not a one-to-one, not coming back, producing the same number of planes before the event as they were after the event as they were before. So the other big economic event going on right now is with the oil space and the oil patch, energy markets. And that was also sort of like the Boeing. It has 2 components, one that's directly related to the coronavirus and social mitigation, the other that is not. And on the supply side, that's the part that's not related. That was the Saudi Arabia-Russia price war, looking at the US as a collateral damage in that, with the Saudis intentionally overproducing through this spring and flooding the world with oil. And now that oil is sitting in storage throughout the world, and storage was getting filled up. So we saw the price of oil falling precipitously through April into early May. And in some cases, on a local spot market basis, some cases actually going negative. So there are places in Texas and the rest of the world where you actually had to pay somebody over the last couple of weeks to take oil off your hands because it costs so much to store it. Good news there is that there has been a deal reached by OPEC. They're bringing about 10%, about 9.7 million barrels per day offline through May into June, but that's not going to be enough. We still have a huge amount of demand destruction that we talked about, and that's the side of the oil story that is related to COVID. So the supply side is not related to COVID, but the demand side is, and that combination of a ramp up in supply at the same time that global demand was falling from oil created that imbalance, and the world is awash in oil right now, and I expect to see fairly low oil prices for some time to come. Normally, low oil prices are good news for the energy consuming states. They're certainly not good news for Texas and Oklahoma, Louisiana. I'm sitting in Texas right now, so not good for the Texas economy, but usually is good news for the East Coast and the West Coast, those energy consuming regions. The problem right now is with social mitigation in place, people are not commuting to work, they're not going to the store, they're not loading up the station wagon or SUV and driving to Disneyland for a vacation. So we're not really seeing the benefit in this economy from low oil prices. It's very one-sided at this point, showing the downside of low oil prices on the producing states without really showing a whole lot of benefit on the oil consuming states. So lots of different forces going on right now in the US economy that are dragging us down in what I believe and many other economists believe will be a historic drop in second quarter GDP. Now that's the bad news. What's the good news? Well, the good news is we're getting a lot of policy put in place from the Federal Reserve, from Congress in terms of fiscal policy, from those two key institutions that are supporting the US economy. And Federal Reserve, we talk about monetary policy, and monetary policy refers to interest rates and money supply. We know the Fed has brought interest rates down to near zero and rolled out a whole bunch of new programs. We'll talk about them in a little bit. We know that the Congress has put together lots of new spending programs and talking about even more spending programs down the road. So, the other thing that we're seeing, and a little note down at the bottom, the Treasury, that's simply referring to the tremendous amount of cooperation that we're seeing between the Fed and the Treasury in terms of funding all these programs, and we can also talk about that in a little bit also. So lots going on here in the US, and on the upper right-hand corner, I've got a little note there to remind myself to talk about the Southern Hemisphere. To date, this has been a Northern Hemisphere event, and when we think about the big economies in the world, China, Japan, the US, Europe, that's about 80% of the US of the total global economy right there. Southern Hemisphere, much smaller countries in terms of their overall economic impact. So as the coronavirus spreads throughout the Southern Hemisphere, we're not really expecting to see compounding economic issues on a global scale, but the local scale there really has a potential for much, much worse effects than we're seeing in the US and elsewhere in other developed economies, because Southern Hemisphere, many less developed or developing economies that do not have the medical capacity and technology that we have in the developed world. And so a lot of concern, and I share that concern for what's going to be happening in the Southern Hemisphere as the disease starts to progress through there. In the upper left-hand corner here, I've got a little note that says first order, second order, and third order. And that tells me that this is a very complicated event. And the way I want to illustrate the difference between a first order and a second order and a third order event or effect is really starting with social mitigation. So we have the coronavirus, and the reaction to coronavirus in the US and many other places has been social mitigation policy. So we'll call that the first order effect. Social mitigation policy has led to an extreme loss of work for many, many workers. We'll call that a second order effect. The extreme loss of work and wages for many workers has led to a huge impact on consumer spending, say auto sales. That could be a third order effect, and so forth and so on. So we don't just have one big effect going on right now. We can think of this as being like a bowling ball dropped into a small pool, like a kiddie pool of water. And that bowling ball causes a big first wave, and we're seeing that wave now. And as that wave sort of bounces off the side and comes crashing back, we got a lot of interference patterns, and soon it becomes a very, very complex event to model. And that's why economically, this is a very, very complex event to model, because we are into the second and third order stages of the coronavirus impact on the US and global economies. And then the final note here on the lower left-hand box, is this idea about what it means to restart. Now, this is currently the hot button issue, because so many state economies are planning their restart. Where I'm located here in Texas, we amongst the early states at the end of April, we started to open up the Texas economy. We go into May, we're going to open up even more. Many industries now are starting their planning to come back and how they need to open up. But the very important concept here is that restart is not symmetrical for a couple of different reasons. One is that we can order a business that is open to be closed. That's relatively straightforward. You cannot open a business that is closed, certainly not if it's failed. You can't order a business that's closed to open. That's voluntary, and that may be impossible for solvency issues. So you don't get a one-to-one restart in terms of the number of businesses that are coming back. You also do not get a one-to-one pullback in labor. Many businesses are going to open, but they're going to be opened at reduced capacity. So maybe they're pulling 50%, 60%, 70% of their labor back, maybe 90%, but they're not pulling 100% of their labor back. So there are long-term impacts on the labor markets here. The other thing we're going to see is a lot of differences amongst regions right now. The governors are getting together and they're trying to coordinate on a regional basis in the Northeast states, in the upper Midwest, on the West Coast, and other areas. But regions have differences. And so let's talk a little bit about some of the key differences. One is the industrial mix. Obviously, Michigan and the upper Midwest, a key emphasis on durable goods manufacturing. Where I am in Texas, impact a key emphasis on energy. Florida, tourism. California, high tech and entertainment, things like that. So every region is different. And so the regional mix is going to have an impact on how quickly the states and local areas come back. The timing of the policy changes obviously is going to have an impact as well. Demographics, is it an older population versus a younger population? Michigan tends to have a relatively older population. Medical capacities, are hospitals operating at full capacity now? Do they have extra capacity to absorb more patients or not? And then finally, when did the disease hit? Was it early in the cycle? Was it late? If you're on the coast, maybe you were an early impact, got an early impact, and maybe on the interior of the country. And in rural areas, you have a later impact. So a lot going on that's going to make for, I think, an accentuated regional pattern to this restart of the economy that's going to be jagged enough to begin with. So it's going to be a very interesting process to get the economy flowing again over the next, say, few months or quarters. Next slide here shows some of what the Federal Reserve has done. First thing they did, of course, was to lower interest rates to near zero. Doesn't do anything at all to fight the disease. But what it does do is it sets favorable conditions for consumers, for businesses to borrow coming out of the disease. So this is a very forward-looking policy. Perhaps it's the easiest thing for the Fed to do, but it also has the least immediate effect because right now we're still in the grips of that social mitigation. So the Fed has said we're going to reset the interest rates near zero, and now they pivot to forward guidance. And we're hearing that more and more with comments from Jay Powell and other people at the Fed saying we're going to keep interest rates low for quite some time until we start to see solid evidence of a return of the U.S. economy, a return to growth. So near zero rates combined with forward guidance is where interest rate policy is right now. The Fed has also indicated it's going to, and already has, ramped up asset purchases. And the Fed in the Great Recession of 2008, 2009, had 3 big rounds of asset purchases. They said back then, we're going to buy $600 billion worth of bonds or $700 billion worth of bonds at a time, and they vastly expanded their balance sheet. What's different now is the Fed has not put a dollar limit on how much they're going to buy. They simply said, we're going to buy enough to stabilize the economy and do what we need to do without a theoretical upper limit here. So the Fed has gone all in on its asset purchases, and that's why you've heard the phrase QE infinity here. They're not going to infinity, but that simply means they're not delineating themselves, they're not boxing themselves in a corner in terms of the amount of bonds they need to purchase. They're going to go all in and purchase as much as they need to, and expand their balance sheet as much as they need to. The other thing they've done is liquidity facilities, where they're going into different parts of the financial market, the financial system, commercial paper, money market funds, things like that, and making sure there's enough liquidity that those parts of the financial system can operate effectively. And just as with quantitative easing or bond purchases, the repurchase operations that inject the liquidity into various parts of the financial market, there's no upper bound there too. The Fed can do as much of that as they need to, and so they really have a lot of firepower left. I don't think they're going to be rolling out many new programs from where they are now, but they certainly have the capacity to expand their current programs, especially asset purchases and the liquidity facilities. The Fed has also undertaken regulatory reform. Wells Fargo had some restrictions rolled back, a very big bank. Community banks had their bank leverage ratios dropped a little bit so they can make more loans, and other big banks supplementary leverage ratio also being dropped so we can make more loans with bigger banks. So lending, the Fed has participated in launched the Main Street Lending Program. That is a new innovation. They're currently working on ramping that up. They've been backing the PPP program that came with the CARES 2 Act, and they've also tried to make the discount window a little bit more accommodative, removing some of the stigma around that. And several big banks have already made sort of token purchases from the discount window just to try to remove that stigma. On the fiscal side, with this slide, we see the several phases of fiscal policy. The first two were fairly small. In early March, we had about $8 billion for healthcare agencies and testing and things like that. Phase 2 came about 2 weeks later with some tax credits, extended unemployment insurance benefits, food stamp assistance. Phase 3 was the big deal. That was a $2.3 trillion program, the CARES Act, Coronavirus Aid Relief and Economic Security Act. And part of that, of course, was the PPP, the loans to small businesses and medium and small businesses, designed to really bridge about an 8-week gap or so the social mitigation policies could break the back of the virus. People were going to get laid off. We're going to try to encourage companies to keep them on their payrolls as much as possible, and then we're going to get back to business a couple months down the road. That was the intent with CARES 1. We saw in late April that the CARES Act, the PPP loans were extended, probably be used up fairly quickly. And now we're already seeing a lot of discussion on both sides of the aisle, both for and a little bit of pushback for a CARES 2. House and Senate Democrats are working to put together a CARES 2 Act, which has been compared, and again, in the words of the politicians involved, to a Roosevelt-like or Rooseveltian fiscal stimulus package. When they use words like that, for me, what I'm hearing are longer-term, more forward-looking programs, perhaps infrastructure and other things, really designed to work over a longer period of time, as opposed to the CARES Act, the original CARES Act, which was designed to work, say, over about an 8-week period. So we'll see, I think, in the next few weeks, we'll see some more definition coming out of Congress about what the CARES 2 might look like, and we'll be able to make some judgments then about what kind of impact it might have on the economy going forward. So a lot of discussion now about the path of the economy going forward. And it really is all about the contours. And this very simple slide here, V, U, L, and W, really describes the contours of that path going forward. I think the real discussion here, more about contours than actual numbers. In my April forecast, I'm expecting a minus 29% growth rate for second quarter GDP. If it's 35%, if it's 45%, if it's 50%, to me, that's not really different. What matters right now are the contours, and we're expecting a steep decline in second quarter GDP. Now, a steep rebound in third quarter GDP, and that would be sort of a very quick restart, getting back to business as usual. That would describe the V shape. In a lot of initial analysis for the event we're in right now, there was a lot of discussion, and I think hopeful discussion for a V-shaped rebound. That is really, I think, evaporated amongst the mainstream of economic thinking right now. Very few of my colleagues in other financial institutions are really expecting anything close to a V-shaped recovery. And indeed, for myself, I would put that as a low probability event, for a lot of the reasons that we've already discussed, how difficult it is to restart the economy, the second and third order effects, and I think we're going to be fighting this for quite some time. The U shape describes a hard down in the second quarter, maybe some stability, a little bit of uptick in the third quarter. And then by the time we get into the fourth quarter of this year and the first quarter of next year, we start to see some sustained and fairly vigorous growth coming out of this. I think that's a much more likely scenario than the V shape. The L shape, and we can think about an L sitting on its side, a Nike swoosh or a hockey stick, if you will, hard down in the second quarter, and then a much more gradual climb out. And this could take a number of quarters to really feel like we've got a lot of momentum going. So I would call that a more of a downside scenario as opposed to the U. And then the W, hard down in the second quarter. We get some relief bouncing back in the third quarter a bit. Virus comes back in the fourth quarter toward the end of the year, toward the winter months. We have to go back into social mitigation. We start to clamp down on the economy again, and then we don't really come back until sometime in 2021. That to me remains a possibility, and we're going to have to look to the epidemiologists to tell us more about that. The other thing I would say about the W-shaped scenario, and I know you've been hearing a lot about this in the news, is that the shape of the W, looking at it right now on this slide, it implies symmetry. We go down hard, we come back up, we go down hard again, we come back up. The W scenario does not have to be a symmetrical scenario. And in fact, if we do have something like that, it will not be, I'll tell you right now, it will not be a symmetrical scenario. We'll see hard down in the second quarter, a little bit of recovery in the third quarter, maybe down again in the fourth quarter, and then some reacceleration in the fourth, so, but not on a symmetrical basis. The other thing I'd like to talk about at this time, and this really gets out of my area of expertise in terms of what the odds are of different patterns of epidemiology. So what I'm going to refer to, because it is outside my area of expertise, I'm going to refer to a document called the CIDRAP Viewpoint. That's CIDRAP, and CIDRAP stands for Centers for Infectious Disease Research and Policy. And that is an academic group, and they put together a good report here that I would encourage you all to read. And they outline 3 scenarios for the progression of coronavirus through the US economy. First scenario, we'll call that a big wave now. Of course, that's what we're in now. And then we'll have smaller waves down the road. And so not a full resurgence, but hot spots developing on a regional basis, and that could last up to 2 years. So we're really talking about an event here that lasts minimum 1 year and up to 2 years in the US economy. Scenario 2, we have the first wave now that we're experiencing, and then a much larger wave next fall. And the problem with that, from an economic point of view and from a social mitigation point of view, is if we do get a large wave next fall, what that's going to require is that's going to require a lot of action in terms of the medical community. It's going to put a lot of strain on hospital systems because it has a longer runway through the economy. If we think about the coronavirus really taking hold in the US economy, maybe we got the initial cases in December. It really didn't take hold until February into March. But if it takes hold earlier, October, November, it has a longer runway through the economy. If it takes hold in October and November, it could also be coincident happening at the same time as a normal seasonal flu outbreak. And that's sort of the nightmare scenario, unfortunately, that we do get a big wave next fall that happens at the same time we get a nasty seasonal flu. And that is almost guaranteed to overwhelm hospitals and require a pullback into fairly aggressive social mitigation. The third scenario is called the slow burn. We have a big first wave, and instead of seeing sort of concentrated waves after this on a regional basis, we just maintain a noticeable level of cases going forward, but really not enough to overwhelm the medical system. So that's the three scenarios that CIDRAP is putting out. What is absent, what is missing from the three scenarios is one and done. And I want to be very clear about that no one in the medical community that I've seen so far is expecting we see this event in the springtime, it goes away in the summer, and that's it. So all three of these scenarios are 1 to 2 year scenarios. Some of them require and imply we're going to go back into heavy social mitigation in the fall. And of course, that would have a major impact on the economy. If we take these three scenarios, and for lack of any other better idea that I have, I'm going to assign about a 33% probability each one. And then we can sort of combine these things and say the first scenario, the smaller waves after, that describes a U and an L. The second scenario describes a W. The third scenario also describes a U or an L. And so that does put the weight of probability on the U to the L scenario, with the W coming in third and the V a distant fourth, hardly worth mentioning at this point. So that's where I am in terms of my analysis about the economic pattern that we're going to be seeing over the next couple of years. So here's what the numbers look like on a growth rate basis. You see the GDP history through the end of last year, and the high point of GDP hitting in the fourth quarter of 2019. Then we see the first quarter of 2020 coming down almost 5% on an annualized basis. And then the huge drop, and this is really the sobering visual here, the huge drop that we're seeing in second quarter GDP. We're seeing it in April monthly data. We're seeing it in weekly data, just literally almost every economic data point we're seeing right now, taking a very big step down as we get into March, April, and May. We get some rebound in our forecast here in the third quarter, coming back even more in the fourth quarter. But I think it's very important to remember that this is not only about the shape of the recovery and contours, but also about how long it takes us to recapture the high point of GDP. So beyond even the shape of getting back to a normal, or what we might call a normal economy, how long does it take to recapture the high point of GDP, that $20 trillion economy, 21, 22, that we saw in the fourth quarter of 2019? In this forecast, it takes 9 quarters to get back to that high point. And amongst my peers, some are calling for less, 6, 7, 8 quarters. Some are calling for more, 10, 11, 12 quarters. And so I'm sort of in the middle of the pack here with this forecast. So it's very important not just to think about contours, but how long it's going to take us to recapture what we had in terms of a $20 trillion economy. And it's going to take us quite some time. And that is also consistent with the CIDRAP report saying that this disease is going to be in the system. We're going to be dealing with this for 1 to 2 years until two things happen. We either get a very effective medical response in terms of inoculation and treatment, or we develop herd immunity, which would require 60 to 70% of the US population to actually get the disease, and that implies pretty high fatalities along with that scenario. So this thing is going to be around for a while, and that's hopefully reflected here in my economic forecast, really taking 9 quarters or so to recapture 2019 Q4 GDP. Next slide should also be very sobering to us, and that's the impact on the labor market. We've seen initial claims for unemployment insurance spiking from mid-March now into early May, starting out zooming up to 6 million or so. We're now down to 3 million for the last report in early May. So relatively speaking, we're seeing that decline in initial claims, but that's still a huge number of initial claims. And if you sum those up over the last 6 weeks, that's about 33 million people in the US economy that are now out of work, out of a labor force of 160 million. So that's a pretty good chunk of the US economy. And then put those two numbers together, and I've given you a 20% unemployment rate. And that is very, very sobering on a short-term basis, 20% unemployment rate. On a quarterly basis, I do show the unemployment rate now rapidly accelerating from a low of about 3.5% in 2019 up to about 15% or so, and then only gradually coming down. My concern, as I've already alluded to, is that we do not get a one-for-one hiring back, and we're going to be dealing with a long-term high unemployment rate for quite some time because of that. Not all companies are going to make it. We know there's going to be a high rate of business failure. Lots of restaurants will not be coming back. Entertainment establishments, things like that. Airlines, cruise. We're seeing a elevated rate of business failure. So not all companies are going to come back. Those companies that do come back are not going to be hiring everyone back. And so that tells me that we're going to be dealing with an elevated unemployment rate for quite some time. I actually have the unemployment rate, that orange dashed line to the right of the peak, coming down a little bit faster than what it came down in the last expansion cycle coming out of the Great Recession. So that's cold comfort, though, given how high that's going to get and given this long-term unemployment problem we're going to have going forward. Interest rate forecast from our April forecast showing the blue line here, the Fed funds rate, that benchmark for short-term interest rates, near zero all the way through 21 into 22. We might shorten that up if we start to see some lift in the economy through the second half of, or especially through the second half of 2021. But the Fed has said they're going to keep interest rates near zero until they see solid, sustained evidence that we're pulling out of this. So this is a very conservative forecast. We might shorten that near zero period up, but we'll stay with this here until we start to get a better sense of what's going to be happening next fall. Other interest rates line up very low, very flat here for the next couple of years. So that's the point forecast. And what I mean by point forecast is that GDP is going to hit this point, declining at a 29% rate. Unemployment rate is going to hit this point, increasing at a 15% rate. Interest rates are going to hit that point. And the one thing we all know about the point forecast, and that is absolutely especially true right now, is it's going to be wrong. There's simply too much volatility, too much variation, too many unknowns to really have a high degree of confidence right now in any one economic outlook. So I really like to put a lot of emphasis in discussion right now on the risk factors. What could happen to make this a worse event than we expect? And what could happen to make it a less worse? I hate to use the word better, simply because the number of people involved in terms of mortalities and very grave illness. But what could happen to make this a better event on the upside than what we might think? So the downside risk, longer shelter in place, that seems to be rolling back for now as we're seeing more and more momentum on the political side and even the financial markets expecting states to start opening up through May and into June. Financial markets starting to respond to that, expecting a little bit more demand growth. But we could roll that back. So we could have longer shelter in place. And if we did, that would be a fundamental economic drag. The other downside risk would be the no summer fade. There were some initial reports and discussions that the coronavirus would fade as we get into the summer. That may not be true. We may see high infection rates going through the summer and require ongoing social mitigation. So key risk factor, fall resurgence. We've talked a lot about that already. Another round of shutdowns because of that fall resurgence. Oil being lower for longer, that ongoing drag in the energy sector, in the oil patch, Texas, Oklahoma, Louisiana, Wyoming, Colorado, Alaska, those states, really getting a double hit now, not just from the overall coronavirus, but specifically due to what's going on in the oil patch. We may have an inadequate policy response. Perhaps we don't get the CARES 2 Act, and it's simply not enough to provide sustained lift next fall when we need it. Second and third order effects, we discussed that, lots of ripples here. Businesses, I think we're starting to see more bankruptcies on the retail side, and we're seeing more adjustments on the travel entertainment side as well. Neiman Marcus, Dallas-based high-end retailer, announcing bankruptcy. J. Crew going into bankruptcy. So we are starting to see those second and third order effects piling on. Housing finance has been a key area of concern. That may be lowering in terms of the risk with some movement here amongst Fannie Mae and Freddie Mac in terms of how they're sharing the risk with other mortgage providers and mortgage servicers. The lingering high unemployment rate is certainly a risk, and the fact that we are not going to see a one-for-one hiring back. State and local government, we're going to need to see some funding for state and local government, and state and local government spending together is 50% larger than federal spending. And state and local governments do not have the ability, by and large, to engage in deficit financing like the federal government does. So we're going to need to see some relief there. And then finally, the black swan or outside the box downside risk is a geopolitical miscalculation. We've seen some saber rattling with Iran. We've had some intrigue with North Korea, perhaps some other things going on, and that now is not the time for that, and it's a very stressed global environment. So I hope we can get through this period here without any type of geopolitical miscalculation. So what could happen on the upside to make this a better outcome than we expect? Well, maybe restart works better than expected. We do get the businesses back. We get an upswing in consumer confidence. We get better than expected hiring. We get the consumer re-engaged and businesses very quickly re-engaged. And we do have more of a V-shaped path out of this. Again, that's a low probability event as far as I'm concerned, but it doesn't mean it's a no probability event. We're going to have to watch the next couple of weeks very carefully. Reshoring. The Trump administration is raising the temperature on this and trying to do things to encourage even more reshoring. I would not be surprised to see more policy, trade policy directed against China, more tariffs designed to encourage more reshoring back to the US. Michigan would benefit from that, a shortening of supply chains. And so a widespread recognition right now that supply chains are too long, they're too complex, they're too fragile, they're too vulnerable. And so I do expect that to shorten up and to see some more reshoring of businesses back to the US. The housing market, lots of upside potential there simply because of two factors. One, near zero interest rates, and the fact that housing was undersupplied going into this. Housing never really caught up with the last expansion cycle we were just in, really just starting to generate a lot of momentum at the very end of 2019 into early 2020. That, of course, has been thwarted now due to social mitigation, but there is a huge amount of pent-up demand for houses, and it's a very tight market. Even though demand may be temporarily reduced, supply is also temporarily reduced. So it remains a very tight housing market, and people need a place to live. And we simply weren't building that many houses in terms of our overall rate of household formation for the last several years. Manufacturing rebound. If we get the supply chain tightening up, we get the reshoring there, we could be in for a nice or high-tech oriented manufacturing rebound in the US. Then the tech sector, making this meeting possible, Zoom and all the other technologies, we know they work, they're going to get better, there's going to be a lot of interest in developing more communication technologies down the road. And finally, I'd like to end here with some thoughts, and we can relate them to the Michigan economy. Not only is this a very heightened period of economic evolution, a severe economic event, it's going to take us many quarters to pull out of this, but as we do pull out of this, we're going to find ourselves in a different economy. The industrial mix is going to change. We know that the auto sector in Michigan has been retooling and gearing up towards more of a high-tech, electric-oriented auto industry. That's probably going to accelerate. We've seen players here, Lyft and Uber, having to make some adjustments. The rental car companies also making some adjustments. So it's unclear whether that demand is going to come back as strong as it was. Social norms, how often do we want to meet? How often do we want to go on vacation? Who do we go on vacation with? Does that affect Airbnb? Does it affect the hotels and motels and all that sort of stuff? So that's going to change business practices. I'm talking to you with a beautiful Comerica screen behind me. On the other side of that Comerica screen is my spare bedroom, and it seems to work pretty well. So I can do my job here without going into the office. And I think we're going to see less than a one-to-one return back into the office after this is over. Attitudes about debt and paying that debt back and austerity are very much in flux right now. We know we're ramping up levels of debt on all sorts, on private, on the public side, and it's going to be a very interesting discussion how we, going forward, once we get the fire put out, how do we repay ourselves for all the debt we're ramping up? Real estate markets, both on the commercial side and the residential side, I think are in a state of flux. Wealth concentration has been a very important issue in the US economy over the last couple of decades. And so far, what I see is the COVID recession or coronavirus recession is going to even enhance that process, really focusing on wealth concentration. There's going to be a very interesting discussion between the forces of inflation and deflation going forward. And so far, my view is deflation wins, at least in the short term, very soft pricing, but 2 or 3 or 4 years down the road, we might look for a snapback in inflation as the economy warms up. The role of government, obviously an expanded role for all types of government in our lives with social mitigation. We'll see what the leftover effects of that are. Supply chain shortening, creative destruction, and regulatory reform going forward, reflecting a new post-COVID economy. And I hope you've got some good ideas from that. I'm very glad to present with you today, and I'd like to thank you all for giving me this opportunity. Thank you.